Don't we rumble? Float like a butterfly and sting like a bee. Ah, rumble, young man, rumble. Down goes Frazier! Down goes Frazier!
It's time to get in the ring with the Cornerman, preparing dentists for the next round. We give you business insights, trends, and timely information. And we'll interview experts to help you make smart financial decisions. Now, here are your Cornermen, Rob Joyce and Mike Bark.
Welcome back to the Cornerman podcast. It's been a little while going over the holidays and some of the stimulus stuff that has come out. As you probably know, and you're probably getting sick of reading, we sent out a lot of emails about PPP loan forgiveness and ERTC credits and all the things that are going on right now. So we thought we would take some time to go over some of the tax law changes that came in the last stimulus and where we think you should be right now, what you need to be doing right now, and those kind of things. So I'm joined by Megan Rakowski, one of our partners at Bull Moose Financial. She's kind of our tax expert in the firm and keeps up with this stuff, is active on tax Twitter. So she knows her stuff. And there's kind of three topics we want to cover with you. The first is we still get a lot of questions about whether or not you should be applying for PPP forgiveness at this point. And the good news is the new simplified form for those who took a loan under $150,000 is now out. And it is a very simple form to fill out. You're basically going to put down some information about your loan. You're going to put in some information about how much in wages you're going to be using toward your forgiveness. And that's pretty much it. You do some attestations to say that you basically use the money for its intended purpose and you understand that this could be subject to audit at some point. But it's an extremely easy form to fill out. And quite frankly, the vast majority of our clients have loans that are under $150,000. So the application in and of itself is not going to be a hard thing to do. And that was really good to see because we were expecting that to be a lot of work early on in this process. Now, having said that, we still don't want you to apply for forgiveness. And Megan will get into this a little bit about the employee retention tax credit. But one of the positives in this recent stimulus bill that came out was if you took a PPP loan in the prior law, you weren't able to take the employee retention tax credit. The new act basically changed a lot to say, not only can you take the employee retention tax credit proactively, but you can go back in time. And if you meet certain requirements, you are able to take that employee retention tax credit now by either doing a tentative claim for refund, which most of you won't be able to do, or amending your fourth quarter income or your fourth quarter 941 return. So where that kind of ties together with your PPP forgiveness application is one of the requirements in this law is you cannot use the same wages for PPP forgiveness and the employee retention tax credit. And you're probably saying, well, that's not really a big deal because we have a 24-week period in which to use our wages up to not only get our PPP forgiveness, but get this ERTC. Where we see the potential problem right now is the PPP application only asks you for a dollar amount of wages on it that you want to use toward your forgiveness. It doesn't really ask what period of time you are using those wages from. And the issue, as I think we see it and a lot of other people out there see it, is if you put an amount of wages down on that particular form, how is that going to coordinate with the employee retention tax credit? In other words, how are they going to know that you're not double dipping? So I think one of our expectations and one of our hopes is that they are going to modify that form slightly to indicate specifically what period of time are you using wages from in the PPP forgiveness application. That way, as they try to marry this to the employee retention tax credit, they'll know that you're using a hunk of wages for your forgiveness and a different one for your employee retention tax credit, and everything will go smoothly from that point on. I think another thing just to understand when it does come time for forgiveness and when we go through that process, in order to get your loan 100% forgiven, only 60% of the costs that you put down need to come from wages. The other 40% can come from things like rent, utilities, and they added a few other expenses in there like PPE and some other measures. So my expectation is when we fill out a lot of these applications, if your loan was, say, $85,000 and you happen to have $120,000 of wages in that period, we'll only use 60% of that $85,000 in wages, assuming that you're going to have enough rent and other costs to cover that. So I think to us, that's why we don't necessarily want you filling out the application right now. You have until 10 months after your 24-week period is over. So that means the people who got their PPP loans right at the beginning of this process are looking at a June or July timeframe for even having to put the application in. And I think our other hope, too, is in terms of getting this employee retention tax credit, right now the rules say we amend your fourth quarter 941. And the only issue with amended payroll tax returns is in a lot of cases it takes a lot longer to get that refund. And the IRS had created Form 7200 with the intent of being able to expedite some of these refunds. So hopefully procedurally, they may create something to kind of honor that intent where we're able to do Form 7200s for people and they'll be able to get their money back quicker if they qualify for the employee retention tax credit. So again, forgiveness does not need to be applied for right now. There's no rush to do it. We understand that it might help you sleep better at night knowing that that's not going to be there. We're going to make sure that you get the forgiveness when you need to get it and that you don't do anything that might screw up this employee retention tax credit. And with that, I just want to kind of turn it over to Megan to talk about the employee retention tax credit, what the specific rules are with it, and how this could potentially be a pretty substantial tax benefit for you.
Thanks, Mike. So part of the CARES Act was the first round of the PPP stimulus and also the employee retention tax credit. But at the time, you weren't able to do both. So most of our clients ended up taking, actually probably all, the PPP loan because that was guaranteed money. And now we see 6 months later, they changed it and now everybody gets to do both. So the way the employee retention tax credit works is if you had a decline of 50% in a calendar quarter over the prior year, or you were shut down by the government, you are eligible for this credit. And we'll get into what does a shutdown mean. And the credit is 50% of employee wages paid up to $10,000. So you could potentially get $5,000 per employee for wages paid. And the period for the one on the CARES Act for 2020 was wages paid March 31st, 2020 through December 31st, 2020. So the max you'll get on that one is $5,000 per employee over that period. Now with this recent law that passed at the end of December, there's a second employee retention tax credit for 2021 wages, and that increases to a max credit of $7,000 per employee per quarter. So that credit will be more substantial. And the requirements to meet that are a little bit easier to meet as well. So I think, most of our clients are going to meet the 50%, well, not most, but a good percentage of our clients meet the 50% decline in gross receipts for second quarter because you guys were not in operations due to recommendations from the government. But some of our clients were seeing emergency patients, so we're not sure if that is going to meet the requirement of fully or partially suspended operations. So I guess the slam dunk is a 50% decline. And then the next step is we would look at people who, because every state was different too, so who was fully or partially shut down.
That's really an area where we want to see maybe the IRS step in and give us a little more clear-cut guidance as to what exactly constitutes a shutdown. Because, if you look at most of our clients, like I said, most of them were under some type of recommendation, either from their state society, or there were some limitations on how they could be open within that period, maybe emergencies only or things like that. And again, that doesn't necessarily constitute a full shutdown. So I would expect, as the IRS issues a few more regulations here, maybe we'll get a little more clear-cut case that if you did not hit that 50% threshold, that we would be able to still, hopefully be able to take that tax credit going forward. And I think, as you said, I mean, the rules for the 2021 employee retention tax credit could potentially be more lucrative in terms of your revenue doesn't have to be down as much, but now you are comparing ultimately 2021 numbers versus 2020 numbers. And we have seen most of our clients return pretty close back to normal operations, so that they may not meet those requirements. But I think the point of the matter is this is something we're going to be looking at probably throughout the first 6 months of this year, letting people know, are you qualified for this credit, and what are the next steps in order to get this money back. So I would expect us to be able to do this, really through probably June of this year. And when it comes to amendments, we have up until 3 years after the filing date to do one. So it's one of those things where there is plenty of time to do it. I think our hope is the IRS will expand the usage of Form 7200 because the reason, again, for that form was to expedite people being able to get refunds and be able to get that money back more quickly into their business versus doing the 941X, which tends to be a process that it takes a lot of time to get that refund money back. So
I can expand a little bit on the 2021 ERTC also. So the declining gross receipts, so 2021 will be first quarter and second quarter, and you just need a 20% decline in 2021 revenue versus 2019. So we're totally excluding 2020, and you're just looking to see were you 80% or higher than 2019, then you're not eligible. But if you have that 20% decline, you would be eligible. And again, it's up to $7,000 credit per employee per quarter. So you could get up to $14,000 per employee if you haven't recovered back to 2019 levels.
Yeah, so I think it's going to be a thing it's a case-by-case basis where we'll be looking at everybody's payroll numbers and their financial statement numbers as we get through the first and second quarter. And certainly if the opportunity is there to get extra money back, we're going to do it. And like I said, I think there's going to be more to come on this law and a little more clarity as we go through in terms of what exactly qualifies as a shutdown and what the best way is to get the money back, whether it be an amended tax return or whether it be Form 7200. So for us, piggybacking on that, one piece of bad news that we've received from quite a few of the states is this past federal law basically came out and clarified everything on the federal basis to say, if you get PPP forgiveness, that is not going to be taxable income to you. And the expenses that you paid using the PPP would be fully deductible to you. So they kind of made that clarification that in no way would the PPP forgiveness be taxable to a taxpayer on the federal level. Unfortunately, at this point, a lot of states, and it's kind of highlighted by the state that we reside in Wisconsin, have come out and said, we disagree with that ruling by the IRS. And in fact, expenses that you use for the PPP loan will be taxable in 2020. So it'll be an add back. If you took a $85,000 PPP loan and you reside in the state of Wisconsin or many other states who are going along with this at this point, that will be an add back to your state's income tax. So what we know now is most states will usually convene sometime around June, because most states are on a fiscal year where they run July 1st through June 30th. And in those meetings, a lot of times what they do is they adopt any federal tax law changes. So for example, if the federal government says you can now depreciate $500,000 in Section 179, usually it takes the state 3 or 4 months to come along and say we agree with that and we don't have to do separate sets of books for federal and state tax purposes. What's unique here is kind of two things. One is this law passed right at the end of the year, and it impacts 2020 taxes. It doesn't impact your 2021, meaning the states are probably going to convene and probably get something done with this after the tax filing deadline, if they get something done at all. I think the second thing at play right now is most states and local governments would love to have more stimulus money from the federal government. So I think this is something they're kind of holding out as a tool or a piece of leverage to go, look, if you guys take care of us in the next round of stimulus, okay, maybe we'll see it your way and we'll agree with the federal ruling on this. I think the problem for us as taxpayers is we can see a situation where if we file by March 15th, we're going to assume that we have to add all of this money back for state tax purposes, and you're going to have to front that tax money. And then the state's going to come in sometime probably around May or June and go, hey, look, we now agree with this, so if you would like to amend your tax return, we will give you the money back. And two problems with that. The first is it creates a lot of work. You're amending corporate tax returns, you're amending personal tax returns, and that comes with a cost. The second problem with it is, again, it's one of those things on amended tax returns. It just, for whatever reason, it takes a long time to get the money back. The state would have to process a ton of amended tax returns, get the money back to you, review all of those. So it's a time-consuming process in terms of getting your money back. So, and Megan may disagree with me here, but I think it's probably best practice until we know more from the states to simply extend corporate and personal tax returns. And that doesn't mean they're not by and large going to be done. It just means they may not be submitted until later this summer. What are your thoughts on that, Megan?
I do agree with you on this, Mike, for the reasons that you said. And then also, I mean, as professionals, like, so much has changed in the past 10 months regarding taxes. We've had a lot to keep up with, and we deal with clients in many different states. I think there's just possibility, if we're rushing, there's possibility for errors. And I think to do a good job as professionals, we need to take the time and make sure that we've gone through everything and that we see how it all is going to play out. So, I mean, I do agree that the states are probably going to come back and make some changes, and who knows federally, but to know the answers by everything by March 15th this year is not probably a reasonable expectation. And I mean, like Mike said, we would continue to prepare the returns. We'll have drafts because I know many people are refinancing right now and need all this stuff for their banks, when realistically the bank will take a draft return or they'll take a copy of the extension for the underwriters. So you don't need to have a complete filed return.
Well, that's a really good point too, is, I think there's always been this perception, and nobody hates extending a return more than me, because for us as CPAs and things like that, I mean, doing the tax work and doing that stuff, I mean, there is some measure of fun to it, and we enjoy doing it. But for us, it's better to kind of get back to normal operations where we're reviewing financial statements with you, we're doing tax projections with you, and quite frankly, just enjoying some time in the summer where we're not grinding out tax returns. So I'm not a huge fan of extending tax returns by any stretch of the imagination, but I think people have always thought that if they extend a return, it's a red flag with the IRS. They're doing something wrong. It causes some weird level of stress within their life, and that's just not really the case. I mean, I can tell you personally, I extend my tax return, really almost every year, just because I'm sick of doing them by the time I happen to get to mine. So I do think the bigger issue for us is what we don't want to have happen is you pay a bunch of money into the state, that gets reversed. Now you're incurring costs for us to go in and amend two different tax returns, and you're waiting for the state to get you back the money. and I think to Megan's point too, it's not only going to be this specific issue with PPP forgiveness, but there are a lot of moving parts right now with state legislatures as how they're going to address a number of items that have changed in the tax law. And March 15th may just be too close to get it done and get a tax return that's complete and you can kind of put in your past and stop worrying about. So it's not that we're trying to get out of doing additional work by telling you to do some of these things. We just really think it's probably best practice at this point that some returns may not be filed until the summer unless there's a real reason to have to go in and do it.
Yeah, I at my old firm, we used to joke we couldn't figure out why people would want a tax return that was prepared on April 14th, because by that point you're kind of burnt out as CPAs. So in that case, I'd choose to extend it and have it filed a week late rather than rush and get out on April 15th.
Well, and that's kind of why we've always put in that standard in our engagement letter, or our tax needs letter that we send out every year, that if you don't have your stuff in by April 1st, we're probably going to extend it anyway. And there's exceptions to that, and some returns get done, but you do hit that point during tax season where there's probably some diminishing returns in terms of the quality of work. And I think anytime you rush through something, either the client omits something that they didn't know was important, or we forget maybe to ask a question that we would in normal circumstances. And this year is just a really big compounded problem with some of that stuff with the states. And I think where they're going to be in terms of their tax law, I think it's going to be an evolving type of situation with them that unfortunately probably doesn't get addressed by them until May or June of this year. Take Wisconsin, for example. There is a bill that's been introduced in Wisconsin to address this PPP issue, but it's a case where we have a Republican legislature, we have a Democrat governor. So is that something that's going to be fixed quickly? I don't see that happening, and there's probably going to be part of some other bill where maybe the Republicans get something they want and the Democrats get something they want, and they're able to come to a peace that way, and we get it done. But I just don't see any way that this is getting done in a lot of states before March 15th. Certainly if it does, we'll be going ahead and filing them, and we'll be monitoring kind of a state-by-state basis as to where they're at in this process and when's a good time to file for them. I think the final issue we want to cover is, as you all know, the new round of PPP is out. It's a pretty simple application, pretty simple standard. You have to be down in any quarter of 2020, and it's got to be a calendar year quarter. You can't take February, March, and April as your quarter. It has to be January through March, April through June, et cetera, et cetera. But if you're down 25% in any quarter compared to where you were in 2019, you qualify for the loan. And from there, if your loan is under $150,000, the SBA is not requiring you to prove that at the time of application, although many banks are requiring you to prove that, either through kind of an internal financial statement, or some are asking for collection reports. Every bank's a little bit different on what they might ask for. The second thing is you can either use your 2019 wage numbers or you can use 2020. And for most of our clients, you're going to use your 2019 because you had a little more payroll in 2019 than you did in 2020, especially if you utilize unemployment for your employees. It's just kind of the way the payroll has been in most of our accounts. If you are going to use 2020 numbers, you will have to have your year-end 940, which either we will have or your payroll provider will have. And they may ask you for your 941s from 2020 as well. The one issue that's giving our clients, I think, some problem is you do have to make an attestation that continued economic uncertainty makes this loan request necessary for the continued operations of your business. So that the first part of that sentence I think people are okay with. I mean, it's a very uncertain time economically right now. And while we've seen some businesses have definitely stabilized, there still is a threat of, well, what if one of my employees gets COVID? Now I'm shut down for 2 weeks. We don't know exactly how this is all going. The second part of the sentence about being able to sustain your business is the one I think that is causing some clients a measure of pause on whether or not they should apply. Because if we look at a lot of clients right now, because of the changes that were made to unemployment, because of the changes that were made to PPP loans and how they were forgiven, because of the HHS stimulus that came out to provide PPP relief for a lot of clients, quite a few of our clients have as good of a balance sheet as they've probably ever had within their business. They're sitting on a good measure of cash. Their operations have by and large returned back to normal in terms of the revenues they're bringing in. Yes, they've seen some, increase in cost and things like that. But for the most part, their business sort of looks like what it did pre-pandemic. So should they apply for this loan? And there's no real great answer for that. I mean, if you have a cash cushion, it's one of those things you'd always like to have a little more of a cash cushion and stuff like that. What I think people should be doing, and this may be some that Megan may disagree with me on, is watch how much you're paying yourself this year again. If you're going to take this loan, your wages, your distributions, and things like that should be in line with previous years, and maybe even a little bit less. Because remember, you're saying you need this money in order to kind of continue the operations, kind of scrape by to make it. And, I just answered a question from a client who said they wanted to take out a bunch of money from their practice so they could do a down payment on a piece of land that they were buying to build a house. And should they do that before or after the loan? And we kind of thought, maybe you shouldn't take it. You're saying, you need this money for your business to go. That doesn't really agree with I think the intent of this law. And not that I think, I don't think a lot of these $150,000 or less loans are ever going to be looked at, but they are all public record. And I think the problem with any public record kind of thing is you can kind of see the news reports going, why are these law firms getting this money? Why are accounting firms getting it? Why are dental offices and doctors getting it? And this poor little restaurant that was out there who maybe forgot to apply didn't get it. And then people start digging into it and those kind of things. So you never know what's going to happen in the future. It's a government program. The government can change the rules. I think 85 to 90% of our clients are going to take the money if they qualify. But do you see any issues with this, Megan?
I agree with your points. And yeah, I mean, do you want, but I mean, on the converse side, with the stimulus money that came out last year, the government just mailed people checks, and how many of those people had no business, didn't need it at all either. It's just extra fund money. I mean, and those amounts are a lot smaller. So I guess it's everybody's personal call on whether they're going to apply. The one thing I talked to a banker, local banker, so there's about 280 billion available, and he said like 35 billion has been accounted for already, so it's not going as quickly as the first time around. But the one comment he made was people are coming at him and applying, and they haven't even bothered to check if they had a decline in gross receipts. So he had like 7 that didn't even have a decline that tried to apply. And the other thing is people are being like really aggressive and, not even putting the paperwork together and making it easy on the banker. And I mean, granted, the banks are making money on this, but if you're going for free money, I think be a little humble and be willing to work a little bit for it, not put it all on the bankers.
No, I agree with that totally. It's one of those things. I mean, you own the business. You have to, at some point, take some accountability for this stuff. I think, we saw a thread out on Dental Town where a CPA that we know had recommended that their client doesn't take this loan at all. And a lot of people coming in and chiming in going, well, you need to fire your CPA because they said that. And the reality is that I think there are reasons to be concerned about taking this next amount of PPP loan. Now, that doesn't mean one shouldn't take it, but at some point you get pieces of advice, you get information, and you do have to make a decision and take some accountability for the fact that you own a business. And I do think, I mean, the one thing I would really caution somebody on, because we've had some clients who have been close to the 25%, and they go, well, is there any way I can get to under, that 25% threshold? No, there's really not. You don't qualify under the law here, and committing fraud on a program like this probably isn't in your best interest for it. So, I think just because somebody expresses a concern with the program or a concern with, hey, this could bite you at some point in the future, you have to weigh that against the pros and cons of it. Certainly we would have loved to have qualified for this next round of PPP as well. We just happen to not qualify for it, so we're not going to be able to get it. And some businesses are going to be in that particular boat. But I just think, understand, if you do take it, be a good steward of the money. I think try to use it for its intended purposes. Get it reinvested in your business to make your business stronger. It shouldn't be a thing where you get a big chunk of money and now you're able to go out and buy yourself a nice new car or take a trip or things like that. And I think so long as you're doing that, you're probably going to be fine. So those are kind of the three big issues that are out there right now. I hope this was helpful as you go through PPP Forgiveness, you go through kind of the taxing. As always, feel free to reach out to us, and we can discuss more in depth your particular situation. And until next time, we'll be joined by Brian Meehan, a Celtic, and I know Megan has one coming up as well.
Yeah, we have Jared Spaeth from Northwestern Mutual to talk about retirement plans in a couple weeks.
All right, well, thanks for joining us, and we'll talk soon.
Thank you for listening to The Cornerman. Be sure to leave us a review and subscribe to us wherever podcasts are found. For more insights and information, visit us at bullmoosefinancial.com.